Okay. I think we're going to go ahead and get us started. It's a few minutes after 4 o'clock. Number one, want to just let you know that this presentation is being recorded. If for whatever reason you're uncomfortable participating in a meeting that's being recorded, please disengage and we'd be happy to send you the recap when it's available. Secondly, I want to just introduce the people that will be speaking today. So as a reminder, I'm Adam Brooks. Peter Eichelberg is our Senior Portfolio Manager. He'll be starting off with commentary around our market outlook and economic outlook as we move into 2025. Debbie Baldini will be talking about how we overlay our process around some technical analysis to determine what our overall portfolio allocations look like and when. Brandon Perlow will be speaking about ESG investing, and we'll explain what that looks like and where that's applicable. Matthew Cherry will be discussing a vehicle that's unique to and applicable to some clients, not everybody, but it's a tool that we've been using called Structured Notes, and we wanted to make sure we spoke a little bit about that. And then Laurel Cutler will be describing the new contribution limits that are available for retirement plans in 2025. And then I'll wrap up. I also want to let you know that you are welcome to ask questions. Please do so by submitting them in the chat feature. So if you're unfamiliar with Teams, in the upper menu there, you'll see in the left hand, I guess it's the third from the left, there's a chat. If you hit that, that will open up a column from which you can begin typing questions that you may have, and we'll leave time at the end for questions and potentially throughout as we move forward. So with that, I want to start us off by, before turning it over to Peter, just letting everybody know a little bit about the process that we go through to develop the investment recommendations that we give to our clients. So first and foremost, all of our advisors sit on our investment committee, which meets approximately every 2 weeks. Peter chairs that committee with an agenda every meeting, and we gather information from a variety of resources to form our own opinions around where we think the market is headed and the economy is headed and what we need to be doing about that. So if there's a main message I would want everybody to know is, number one, there is a process, and for better or for worse, we own the results of the investment accounts. Secondly, that we are independent in forming our own judgment. Although we do a lot of homework and research and reading, we're forming our own independent research. And lastly, that the security selection is agnostic. We do not care what the name is on the front of a particular investment vehicle. We simply want to find the best vehicle that applies to what our clients' needs may be at the time they need it. So with that, I am going to turn it over to Peter to describe our 2025 market and economic outlook. Peter, the floor is yours.
Okay, thanks, Adam. Everyone can hear me all right?
Yes.
And you can see the slides on the screen? Perfect. So I'm going to do a quick summary of 2024 for context and talk about 2025 outlook and views. Situation is always changing, as you know, but this is what we think right now. The S&P 500 finished up its best 2-year run since the late 1990s, and that's mainly due to the explosion in artificial intelligence, the technology sector. We saw really good gains in communication services and actually also gold as well. On the screen, you're going to see what's called a quilt chart that ranks ranks the different types of investments from top to bottom with their return numbers, and you have the years, and you'll see that there's not a discernible pattern, but there have been runs of certain types of assets over a several year period. We're finishing up a 2-year run for US large cap, and there's a very large spread between how US large companies did versus everything else in both 23 and 24. That's going to end eventually. We're going to talk a little bit about that going forward, but I want to point that out because we believe in diversification and we invest in other markets besides the US large cap. Being diversified is a wise long-term strategy. Sometimes the concentration can get you better returns in the short run, but it also exposes you to a lot of risk. A lot of what happened in the US large company market had to do with what we're calling the Mag 7, the Magnificent Seven. That's a group name given to 7 technology stocks, and those are Microsoft, Google, Tesla, NVIDIA, Apple, Amazon, and Meta. And what I'd like to point out is that this green line is those 7 stocks as a group performing over 21, 22, 23, and 24. The black line is the S&P 500 over that same period, and that includes those stocks. Now the concentration's around 30%. And then the blue line is if you had the other 493 or so stocks, how they would have done over the same time period. Huge difference. Huge run up in that one area, and something that we want to keep an eye on because the valuations have really gotten stretched there. So speaking of that, the trend could continue, but it's very rare to see 3 years in a row of double-digit returns to the stock market. We have reasons for believing that we might even see some kind of a sell-off sometime in 2025. But I want to talk about value and growth stocks. These Mag 7 and a lot of other companies are called growth stocks because the investors are willing to pay a premium for increasing earnings, even though the price has gone pretty high relative to those earnings. And then value stocks are the flip side of the coin. They're the kind of stocks where there's a discount, maybe the stock's out of favor, and they haven't been priced as well by the market. The panel on the left here shows the relative cheapness of growth stocks on the top part and value stocks on the bottom part. And just wanted to point out that given this big run up in US large company growth stocks, we now have almost a historically low price in value stocks. Eventually markets discover, hey, there's bargains out there and money can move in that direction, although we can't say exactly when. But I wanted to just put that in people's minds. Well, let me go back a second. I'm not ready for that one yet. So our markets have been and are still buoyed by expectations of tax cuts, pro-business, deregulation, an apparent continued economic soft landing, and ongoing interest rate cuts, although yesterday we found out that the Fed wants to put those on pause. Investors still seem hopeful that the new administration will be able to extend the Tax Cuts and Jobs Act, and that these policies may help lead to better corporate earnings, personal income, and spending, although that's not guaranteed either. We're also relieved to see that the world's hotspots have cooled down a little bit with ceasefire agreements and a little more calm there. Could flare up at any time, but right now we're enjoying that. We expect as a firm that the artificial intelligence revolution is going to extend to other industries besides just the chip makers and technology companies, and that will help them to innovate, cut costs, and boost earnings, and that should allow the market returns to broaden out to other sectors. We do think this is a transformative way of doing business that's going to affect everybody over time, but the prices are high, and if you just look at Monday, NVIDIA had a 17% drop in one day because of news about another technology out there that could undercut its pricing power. So we've been saying for much of 2024 that markets have priced in perfection. We need continued good news to sustain that. The S&P 500 is priced about 22 times earnings. That means that the price of stocks reflects about 22 times per dollar of earnings, and that's looking forward. Backwards, it's even higher. And that's on it. If earnings come in lower, or if the sentiment starts to lead to a lower price to earnings ratio, we might see some volatility this year. When you buy stocks at a high price to earnings multiple, the future returns tend to be lower on a pretty consistent basis. This shows the returns over the next 5 years against the price to earnings ratio paid, and we're right about where the red block is. So there's a fairly consistent trend here that returns to stocks, the ones that have gone up a lot, might be lower over the next 5 years. That should pour a little cool water on the desire to jump on the bandwagon. And the other thing is on the bond side, it's different. We're around here for current bond yields, and the bond yield now is a very good estimate of what the future returns will be on those bonds for the next 5 years, and that's around 4.5% to 5%. But there's so many other things we could say, but I have to finish up to be able to move on to Debbie. I just want to say we have an optimistic right now, but cautious outlook for 2025. We think that it's possible for stocks to have another positive year in 2025, but certainly it's a hard sell to get to 3 and 4 years of that. So we invest in a diversified manner to have to help reduce the downside risk. And also, as Adam mentioned, we talk about the markets and look for opportunistic and defensive moves that we can make. And I'm a little over my allotted time, so I want to give it back to Adam so he can introduce Debbie to talk a little bit more about how we do this.
Technology is great. I need to remember to unmute myself. So Debbie, before I turn it over to you, as it relates to how we are positioning portfolios based on what Peter just described, what hopefully you're gleaning are a couple things. Number one, that we're not chasing returns, and we're not chasing, in particular, the Mag 7. We have a bit of a value tilt to our portfolios currently, and on days like we saw earlier this week, that turned out to really benefit how the accounts held up. I would also just add that we are not nearly as concentrated in any one asset class in general. So the fact that we will also incorporate international small cap, value versus growth, bonds, all of this form the overall strategic allocation that we are using to help our clients achieve their goals. One of the things that we're proud of is that, most advisors and most firms simply stop there with developing the strategic allocation. Debbie has brought to our team the ability to apply technical analysis, which is a whole different language. It's a whole different animal that incorporates the use of following charts and MACD and relative strength and momentum. And this is allowing another layer of risk management and possible opportunity seeking by being a little bit more tactical. So with that, Debbie, the floor is yours.
Okay, let me share my screen.
I think there we go.
Okay.
Here we are.
It's a good thing I'm doing technical analysis and not some kind of, technology, seminar or something. Anyway, I apologize, everyone. All right. So as Adam said, and as Peter, as you've seen from Peter's presentation, there are a lot of different things that we look at here at Able in managing your investment portfolios. My specialty is technical analysis. You can hear everybody okay? My specialty is technical analysis, which is the study of charts and indicators. So I will be focusing on 4 important and timely charts that I follow very closely. This first chart that we're looking at is a 10-year chart of the CPI and the PPI, the Consumer Price Index and the Producer Price Index. The Consumer Price Index measures changes in the prices paid by consumers for a basket of goods and services. And the PPI measures the average change in selling prices that producers receive for those goods and services. The important thing about this chart is that it shows how the PPI tends to lead the CPI. One of the things that is very important about analyzing charts is it helps us to calculate the odds or the probabilities of what's going to happen in the future. So when we have an indicator like the PPI that leads the CPI, it gives us a leg up in estimating whether we're going to see inflation rising, remaining stable, or perhaps even coming down. So as you can see, the PPI, the orange line, crossed above the CPI in 2017 and then again in 2021. Both times, in both cases, inflation was heating up. Of course, in in 2020, 2021, it was a much bigger rise due to all the stimulus from the COVID government measures. So, but the point is that that as we can see, with the CPI, of course, the PPI rose above the CPI, peaked out there in the early 2022, and actually crossed down somewhere in the middle of 2022. So that was an indicator that we had seen the worst, that inflation had peaked, and that actually was a very bullish signal for the stock market at that point in time. So if we fast forward to today, what we see is, for the first time, since that crossover to the downside, the PPI has once again crossed to the upside. All other things being equal, that is giving us an early warning sign that inflation may be poised to move higher, with obvious implications for interest rates and the stock and bond markets. So if I go to the next slide here, this is a slide showing the 2-year Treasury, the 2-year Treasury note versus the Fed funds overnight interest rate set by the Federal Reserve over the last 5 years. The important thing about this chart is that it shows the 2-year Treasury yield historically leads, once again, we have a leading indicator, historically leads the Federal Reserve overnight rate. The 2-year yield started to rise in mid-2021. The 2-year yield is the black line, started to rise in 2021. And the first rate hike by the Fed followed nearly 9 months later, with a lag of 9 months, in March of 2022. The 2-year yield peaked, continued to rise, and then, the Fed was playing catch up basically with the 2-year yield, continued to rise into 2023, when it peaked at a little bit over 5%. And at that, what you see here is that the Fed paused their hiking cycle when the 2-year yield paused its rate of increase. So since that time, the 2-year yield then dropped from over 5% down to 3.5% here by September of 2024. The Fed followed suit with 3 rate cuts at their meetings in September, November, and December. Since then, the 2-year yield has backed up from 3.5 back up to 4.25, 4.5. And the Fed, not surprisingly, announced yesterday that it will stay on hold with the target Fed funds rate at, guess what, 4.25 to 4.5. So for investors who expect more rate cuts in 2025, I say watch the 2-year. If the 2-year rolls over and goes down, we will likely see more rate cuts. If the 2-year breaks out over the Fed funds rate, it will put pressure on the Fed to keep rates higher for longer or even raise rates. So it's something to watch very closely. In the next chart, I overlaid the previous 2 charts, the chart showing the CPI and the PPI, and the chart showing the Fed funds rate. What's important about this chart is the wide gap that has opened up between the two. The light blue line is the Fed funds rate, and the blue and the orange lines are the PPI and the CPI. The same thing happened in 2018, although the gap today is even wider. It's important to remember that when the Fed funds rate is above the inflation rate, as it was in 2018, as it was in, as it is now, it means that real rates, interest rates after inflation, are positive, monetary policy is restrictive, and all other things being equal, a drag on growth. Conversely, when the Fed funds, which is again the blue line here, the light blue line, when the Fed funds rate is below the inflation rate, like it was in 2020 and 2021, it means that real rates are negative. Fed policy is stimulative and supportive of growth. So that we saw the big run up in 2021 had a lot to do with the fact that real rates were negative. And that's very, very positive for asset prices. Not so much here. We have this large gap here which is telling us the Fed is, despite the fact that it did cut rates, 2 or 3 times there, is still very restrictive. The gap will close. This gap will close like it closed back in 2018. The main question is, how will it close? Either will it close by slowing growth and more Fed rate cuts, like happened in 2018 as growth slowed, the Fed began to cut rates, or will it close by rising inflation and no more rate cuts? Which way it closes will have a big impact on how the different asset classes perform this year, and we will be watching it very closely. Obviously, what we would prefer is to have it all, which would be more rate cuts and lower inflation, but higher growth. So we'll see if we get that. Okay, the last chart is one of the most important ones, in my opinion. It shows the S&P 500 index, which is the orange line, and the National Financial Conditions Index, the NFCI, which is the blue line. The NFCI is a weekly index published by the Chicago Fed that measures the financial conditions of the United States. Low readings on the NFCI indicate financial conditions are loose, while high readings indicate that financial conditions are tight. Both the S&P and the NFCI are leading indicators of the economy. And as you can see, they are almost perfect mirror images of each other. This chart shows the critical role that liquidity has played in financial markets since the financial crisis in 2008, and especially since COVID. Both indexes are extended and vulnerable to a reversal. The message from this chart is, enjoy the party, but dance near the door. Needless to say, we will be watching this one very closely. Thank you for your attention.
So great job. Thank you very much, and appreciate the comments here. There's a couple things that I would want to maybe put a bow on as it relates to the comments here. And as a side note, just a reminder, if any of our participants have questions or would like any follow-up on this, please feel free to write your question in the chat, which you can see in the upper toolbar there. It's the third one on the left. Feel free to type in your questions, and we will open it up to addressing those near the end. But here's what I would say, hopefully you're gathering. Generally speaking, we are fairly cautious around our outlook right now. There's reasons to believe that inflation may not come down as quickly as many people expect. There's concerns that interest rates may remain higher for longer. AI enthusiasm, which has been a big driver of market performance. You can see just what happened this week, how quickly that sentiment can change and what that can mean for the markets. So we tread cautiously, and I will say most humbly that if we make a mistake for our clients, it's on the conservative side of the equation. We are not the firm that is going to shoot for the stars and hope we hit the moon with our clients' money. That doesn't mean that we are going to be oblivious to seeking growth, but we want to be cautious so that our clients can enjoy their retirement and sleep well at night along the way. So I'm going to move forward. Brandon, among other things, specializes in an area called ESG investing, which simply allows us to help our clients that wish to invest along their values to be able to implement that. And Brandon, I'll turn it over to you to walk us through this, please.
Awesome. Thank you. Thank you, Adam. Thank you, everyone, for being on the webinar this afternoon. One thing that I would add, everything that we've heard so far from Adam, from Peter, from Debbie really applies to everybody, to all of our clients, across all of our investments. ESG investing is something that a number of years ago, a number of our clients specifically came and asked us to put these models together, and we've been running them ever since. So part of this is just to share that, hey, this does exist. If it's something that you're interested in, please reach out to us. We're happy to have a conversation around it. I want to start by defining ESG. So if you don't know, E is environmental, S is social, G is governance. And what we have found looking at some of the academic research is a couple of things. So I had a chance to meet Dr. Pruitt at ASU last year, and there are findings now that, as you can see highlighted here, we can modify stock portfolios to achieve ESG goals without sacrificing returns. That has not always historically been the case. So that's a big, development just over the last couple of years. The other thing that I want to call out here is, we separate the E, S, and G, and the E factor, the environmental factor, is much more statistically significant than the social and governance factors. So we're not finding, an ability to maintain risk-adjusted returns when we focus on the social and governance aspects, but we are able to do that on the environmental side. 3 levels of ESG funds. So, very quickly, there are ESG screen funds where, there's ETFs that say we're just going to avoid tobacco, or we're just going to avoid coal. And that's a very light screening. There's ESG Advanced, which is kind of the other end of the spectrum where focusing on environmental, social governance practices, that is actually a higher priority than the returns themselves. We focus in the middle, this ESG aware section where, we're trying to screen these funds for our ESG models, but we're trying to do it with a very similar risk profile to the market overall. And our goal is to maintain risk-adjusted returns while we're implementing these ESG screens. How do we actually do that? So, this is a slide that is tied to the biggest fund that's in our ESG models right now. We look at the entire stock market to begin with. We avoid companies, that are involved with ESG issues, and we'll give some examples of that in a moment. We have a profitability screen as well, which is not inherently ESG related, but this is how we maintain the risk-adjusted returns over time. And that's how we get to this ESG responsible, sustainable investment universe in the funds that we're using. To focus on the E aspect, the environmental aspect real quick. So again, the largest fund that we're using right now in our ESG model specifically has very similar risk-adjusted returns to overall equity markets. But I want to call attention to this. How do they actually do that? From an environmental standpoint, we look at carbon emissions intensity. So this is the amount of carbon dioxide emitted per $1 million of revenue for the company. And if we look at equity markets broadly, it's about 115 tons of carbon dioxide per $1 million of revenue. we're able to do this at 36.4. So that is a significant reduction in emissions, about 68%. This fund also largely eliminates oil and gas revenue. And the key from our standpoint is it's, focusing on these positive environmental aspects while maintaining very similar risk-adjusted returns to what our other models would otherwise be doing. Just to give a few examples of some companies that have been screened out, you can see them listed on the screen here, but these are some of the things where, again, the focus is mainly on the environmental. There are some social and governance screens as well. And I'm going to stop there. It's already been about 5 minutes. But just to reiterate what I've said, if this is something that you're interested in learning more about, there is a lot more information that we're happy to share about it. And so please feel free to reach out to me or your advisor, and happy to have that conversation. I'm going to turn it back to Adam.
Thanks, Brandon. Before I turn it over to Matt, I want to address a couple of the questions that have come in through the chat, all of which more or less relate to the new administration and how we are paying attention to fiscal changes. And I would say that there are 4 main agenda items within this space that we're paying very close attention to. The biggest one, and the one that we feel could have the largest impact, is frankly the debt and level of deficits. So this is one that we're paying very close attention to. The reason why this matters is because the U.S., unlike every other country, at least at this point, we have the benefit that the U.S. is viewed as the reserve currency, and secondly, the U.S. Treasury bond is viewed as a safe haven. And if the new administration and Congress are seen as deficit busting and they completely expand the level of debt, that could jeopardize both of those advantages. That would be a very big negative. So it's something that we have to wait and see. And, it certainly is part of why you saw late in December interest rates move up. So there's a phrase that is referred to as the bond vigilantes. And sometimes the bond market is referred to as the smart money. They're anticipating risks to the market, often ahead of the emotions and momentum that may be driving the stock market. So we pay very close attention to the 10-year Treasury as well as other yields, because that has an implication on a lot of things. So number one, the debt and deficits are something that we're paying very close attention to, and is we're going to have to see how things play out. Secondly, are tariffs. So big hot topic these days, and what I would say around tariffs are that they create a level of risk. That number one, they can hurt economic growth as well as boost inflation, which is essentially the definition of stagflation, something that we definitely do not want. But as we know, tariffs can be viewed as both a negotiating tool as well as a potential economic tool. So the devil's in the details here. It's something that, again, we have to pay very close attention to. I think that if we take a hatchet to something that would be better suited than with a scalpel, we could create some major problems. Our assumption at this point, our view at this point, is that a lot of the rhetoric that we've heard thus far is largely negotiating in nature, and that we will see some level of tariffs enacted, particularly against China. And that may not necessarily be a bad thing when it's all said and done. So that's number two. Number three are taxes. We do expect that the Tax Cuts and Jobs Act get passed, but it may not be until the end of the year. Again, timing matters on this, and would have a benefit to the economic growth and the level of growth if we're able to reduce taxes, but not in a way that jeopardizes deficit spending. Again, that's something that we'll have to pay attention to. And the last one, it's a big topic, has to do with immigration. This is a little bit of a political hot potato, which I am absolutely going to avoid getting into. But what I would say is that it's, what we do know is that our economy does rely on a level of low cost labor, and if some of the immigration rules are enacted where that jeopardizes that to a large extent, that will have an economic impact. Again, we have to wait and see how things play out. To be equal, the other side of that argument is that the immigration policies are somewhat net neutral in the sense that you're not necessarily going to have a shortage of a workforce because the demand on the system is less as well. So I'll leave it at that and just say those are the main things that we're watching as it relates to the new administration and fiscal policy. Structured notes are complex securities. They are not for everybody. They are limited to accredited investors and more sophisticated investors. However, they are a tool in the toolbox, and when appropriate, we use them. At the same time, for those that may not be eligible or it may not be appropriate specifically for structured notes, there are other vehicles that we often use to create the same results. So Matt, I'll turn it over to you to define what the heck I'm talking about when we say structured notes.
Thank you, Adam. Hi, everybody. Thanks for being here today. To respect your time, I'm going to jump right in. So structured notes, they're alternative investments. They've been around since the early 90s. They become much more popular in the last decade. Today, there's over $3 trillion invested in them globally. So we've been discussing using them in our portfolios in the last few years. We have had the option to use them. We didn't like the options available in our old setup. One of the advantages to us moving to Pershing is having the open architecture to create a strategy that allows us to be consistent with our approach. So we have been implementing them for almost a year and a half, and we have been very happy with the outcome so far. So at their core, a structured note is a debt obligation or bond that is combined with a derivative component like an option. Okay, the structure of these allows for downside protection with the opportunity to participate with market-like returns. Now, there are many ways to structure these, and we spent a lot of time and energy researching the right strategy for our clients. We've been very deliberate and intentional about how we built these, and there are 5 main components to them. Now, each note tracks 3 indices, the S&P 500, the Russell 2000, and the Dow Jones. However, performance is based on the worst performing index of the 3, which means returns are tied to the weakest link. And we have the call factor, or the expected return. One of the advantages of structured notes is that we know the potential return before we even invest. Now, typically we've seen low double-digit returns if conditions are met, but there is a cap on the upside, meaning that you may not capture all of the market gains. The term is pretty straightforward. It's a 5-year term, so we don't want to lock up any money that we might need for short-term goals. However, there are call terms. These are auto-callable annually. So these notes are evaluated every year. If on the anniversary date, if all 3 indices are above their starting levels, then the note is called, meaning you receive your original investment plus the preset minimum, or the call factor in this case. If it's not called, it continues until the next annual check, repeating this process until maturity. And then lastly, we have the barrier or downside protection. Now, at maturity, as long as the worst performing index has not dropped more than 30%, then your principal is protected. However, if it declines below the 30% you would experience a loss in proportion to the decline. Now, what I've done here is I've taken information directly from the prospectus from the last note that we purchased. I want to direct your attention to the first column here and the third column here. So this shows the observation dates or the call dates, and then the amounts that that you would receive if the note is called. We purchased this note in January of this year. So this first line here shows January of next year, if the note is called, you'll receive the $1,000, and these are purchased in $1,000 increments. So for each $1,000 purchased, you'd receive your premium principal back plus $123, which represents a 12.3% return on that note. If this is not called in the first year, nothing happens and we roll to the next year. And so in 2027, if the note's called, meaning all the indices are above, are positive, then instead of $123, you would receive $246. That's 12.3% from year one and 12.3% for year two. And again, year 3 and 4 are the same. So if it's not called here, there's an opportunity to be called here and here. And again, at maturity, it will grow again. And so if it's positive, if it's negative 4 years in a row and positive at maturity, this particular note turns out to be a 61.5% return. If it's still negative and we're not down below 30%, then we receive the principal back for the $1,000. If the worst performing index falls below 30%, then we do participate with the market, meaning that if the market's down 32%, we are down 32% for that particular note. And so that brings me to the risks. Now, if you couldn't tell from the previous slides, these are very complex. There's a lot of moving parts to them. So that's why Adam mentioned it, we mentioned it. We reserve these for high net worth accredited clients. We want to make sure you fully understand and take advantage of the benefits. There is market risk. I went over that. If the market's down more than 30% at maturity, you will participate with the market. The issuer risk, the structured notes are issued by financial institutions. They're subject to the credit risk of that issuing bank. If the issuer were to default, investors may lose part or all of their investment, regardless of how the market performed. Now, to mitigate that risk, it's important to note that we're only using highly credited banks, banks that are deemed too big to fail. We are also diversifying our risk among different banks. We purchase these every month. And so we are making sure that we are not putting more than 25% of our notes in any one specific bank. So there is liquidity risk. I went over that. Again, want to make sure that we're not using anything that we need within the next 5 years. And then lastly, the capped upside. If the market does really well in the first year, well, yeah, the note will be called, but there may be missed opportunity in the market. But that's why we're only using this for a portion of the portfolio. So why would we choose structured notes? This year, as you've heard from others, we expect uncertainty this year. Clients are looking for growth while having a level of downside protection. Structured notes offers both of those. So if you're not currently using structured notes, but are curious about how they might fit, happy to talk, happy to go over the ins and outs of them and see if they fit in your portfolio. Again, if they're not a right fit for you, we do have other options like ETFs. They provide similar features with a different format. So I'm probably over my time. Adam, I'm going to hand it back to you, but thank you guys for joining us today.
Couple questions came in related to structured notes. The first is, we say these are limited to high net worth. So technically, an accredited investor is an individual with at least $200,000 of income, $300,000 if it's married filing joint, or has a net worth of $1 million or more. So that's generally where they become available. There were additional questions though, Matt, that maybe you can help address. And that is, number one, do we want the note to be called sooner than the 5 years, or is the ideal scenario that these are held to maturity?
Well, really, it doesn't matter. We're happy either way because we've seen a pretty consistent anywhere from a 10 to 13% return when we're purchasing these. And so if it gets called in the first year, we're happy that we received that double-digit return. At the same time, we're not overly concerned if it doesn't, because we know that we're still locked in with a double-digit return the next year if it gets called. And so this is one of those things where, like anything else, it works until it doesn't. And if we see that the returns are not consistent or not continuing to be as consistent with the double-digit returns, we may discuss if changes need to be made.
So, and then lastly, the yield that we're getting, or the premium that we're getting, compound or simple interest, and any comments around the dividends and interest of the index?
Great question. So it is simple interest, and this does, you do not participate in the dividends or interest of the underlying indices.
So thank you. So where these can be nice is, in particular, a sideways type market where we're not necessarily having the 20+ returns of the S&P 500, but if we're getting modest returns and we want some downside protection, this is a vehicle that often fits that scenario. And when Matt says that, hey, it works until it doesn't, what he's really referring to, my seat just fell. What he's really referring to is the fact that we are customizing these. We are literally building these for our clients, and we have a formula that we think works really well right now, but we need to adapt that formula when the output is not where we need it to be. So thank you, Matt, for the presentation. I want to, the last topic that we have for today's webinar is a bit of a tease for the webinar that we're going to be hosting in February that Laurel Cutler will be leading. And it's going to be a much broader conversation around retirement plans and saving strategies to give us a little bit of a preview in terms of contribution limits into retirement plans for 2025. And I'm going to try and fix my chair in the meantime.
Good deal. Thank you, Adam. And thanks everybody for attending. Are you guys able to see my screen okay? Retirement plan? All right, good deal. So for 2025, we did see an increase in retirement plan contribution limits. So this provides an even greater opportunity for you to boost your retirement savings for this year. You can refer to this chart for a breakdown of limits by plan type. And for employer-sponsored retirement plans, so that's going to include your 401ks, your 403bs, 457s. The annual contribution limit did increase by $500 this year for a maximum amount of $23,500. Now, if you are over the age of 50, you can make an additional catch-up contribution of $7,500 for a grand total of $31,000. Now, new this year, this is for any individual who is between age 60 and 63. You can contribute an additional $11,250 for a total contribution of $34,750. So again, if you have an employer-sponsored plan and you are between the ages of 60 and 63, this will be a great opportunity to contribute even more towards your retirement. So really consider taking advantage of this and increase your contributions if you do fall in this age group. Simple IRAs also had an increase of $500 for a total of $16,500. And then those who are age 50 and older, the contribution of $3,500 stayed the same, but your grand total is now $20,000. Traditional and Roth IRAs contribution limits did remain the same from last year. So that total amount is $7,000. And then for those over 50, you get the additional $1,000 there. If you have any questions on any of this, or if you want to review your contribution strategy for the year, please don't hesitate to reach out to the team, and we are more than happy to help you out.
Awesome. Nice job. So a couple quick things on the 401k and IRA contribution limits. Number one, not too late to make IRA contributions for 2024, even though we're now in 2025. You have until April 15th to make those contributions, unlike retirement plans, which needed to have been in by the end of the year, except for profit sharing and things along those lines. Also want to just remind that one of the strategies, all of what we just described really pertains to people that are still working and accumulating. One of the strategies that we often use for our retirees where their income has come down because they're no longer working, a Roth conversion strategy can make a lot of sense so that we take control of disinheriting essentially Uncle Sam.